It's Alibaba and executive chairman Jack Ma's big day when the Chinese e-commerce company starts trading on the New York Stock Exchange. You've already heard the staggering numbers. At $68 per share, analysts keep pointing out it could be the biggest initial public offering ever. Still, as enticing as Alibaba might be to a professional investor, there are some risks. First, Chinese law bans certain kinds of foreign investments, so
You're buying shares of Alibaba through a contract rather than direct ownership, which of course gives the Chinese government the ability to essentially revoke that license.
That's how Chinese companies traded outside of China work. In the investment world, it's called a variable interest entity. And while his rags to riches story has made him something of a media darling, critics say Jack Ma will be hard to control. The New York Times points to the time he spun out Alibaba's third-party online payment business and the time he allowed the company to loan one of its founders $1 billion. But for all the concerns, there's a lot of allure for a would-be investor. Consider this: 88% of Americans have never heard of the company. That's a whole bunch of unexposed, potentially new customers when Alibaba further expands a US version. So if you're an optimist, a lot of room for growth there, and considering the low cost of operations, Alibaba has shown pretty impressive profit margins. For Newsy, I'm Christina Hortman.